Right, good morning everybody. I can see from the list of participants we've nearly got a full house and it's 9 o'clock, so I will crack on. My name is Chris Humphreys, I head up the tax team here at BHP, and it's my great pleasure to welcome you all to our review update of the summer statement presented by Rishi Sunak yesterday. I was going to introduce today's session by saying that it only seemed like yesterday that we were together in March talking about the budget on the 11th of March. But reflecting on that, and if I'm totally honest, it seems a million miles away and totally divorced from the state of the economy and the world that we're in today. A totally different world. It was probably the last time I wore a suit. It was definitely the last time I had a decent haircut. But it was also, if we reflect on it a bit further, the first sight that we had of Rishi Sunak as our Chancellor of the Exchequer, because from memory, it was only 28 days in advance of that budget that he was sort of thrown in at the deep end and expected to deal with the first indication of COVID. And what we ended up with was a split budget, one that dealt with the future and some fairly structural changes to our tax system, and one that dealt with the initial impact of COVID-19. And I think the first bit, the one for the future, has been parked because quite clearly everything is focused now on what effectively became on the 23rd of March, a complete mothballing of our economy and a significant lockdown and the impact of that. Nick, if you move to the next slide. So what did we get yesterday? Well, the announcement said that we will still get a full budget and a spending review in the autumn. Just to put into context of where we are in relation to government intervention, the announcement of measures in the previous 2 or 3 months come to about 163 billion. The measures announced yesterday come to about 30 billion. So it's clear that there is still some way to go in terms of the structural change to our tax system and how we're going to pay for that deficit. So quite clearly, the spending review in the autumn and the budget attached to that will be hugely significant. What effectively we got yesterday was a mini budget with specific measures to insulate people and businesses from what they referred to as the ravages of an economic winter. As they say on Game of Thrones, winter is coming, and quite clearly the Chancellor is hugely concerned about how we are going to come out of this lockdown. We have experienced a 25% drop in GDP over 2 months. We've got the worst recession, we believe, since the Great Frost of 1709. I remember the winter of Lodgemore of 1973, and that was bad enough. And an anticipated 2 million increase in unemployment post the job retention scheme, and real structural issues in things like retail, hospitality, construction, housing. And I think the caveat is that there is a total lack of visibility about what the new world's going to look like. The introduction of the measures yesterday is a first step at trying to address that, but we're still a million miles away from understanding what the economy is going to look like and what impact these measures and additional measures are going to have. We've assembled a crack team of tax professionals to talk you through all the detail on this. I tried to come up with a collective term for tax professionals, and all I could come up with was a legislation of tax professionals. Answers on a postcard if you've got something better. As it's a webinar, you'll see that you've got the ability to join us in either a chat or a question and answer. We'll be keeping an eye on that as the webinar goes along. So we'll post questions as we go, and then there'll be an opportunity at the end for questions generally. And at this point, I'll hand over to Zoe Roberts, one of my fellow tax partners.
Hello, everybody. So yes, I'm going to just run through some of the detail around the CJRS, the furlough changes or no changes that are coming in, and some of the job retention incentives and creation incentives that were announced. So just as a bit of a reminder, which seems slightly crazy for something that was really only introduced 3 months ago, but there's been quite a lot of change to the CJRS scheme, so I thought it worthwhile spending a couple of minutes just reminding everybody of where we are at the moment. So we had CJRS 1, which ran from 1st of March to 30th of June, but was actually only announced on the 20th of March. So we're in the situation of having something that started before we even knew it existed and or what the rules were. So broadly for the first range of furloughing, it was an 80% on the furloughed staff costs. So you could claim 80% of the wages, the national insurance, the pension, subject to a cap of 2,500. And the key point was that staff couldn't work at all whilst they were furloughed. So that scheme ended on the 30th of June. Claims must be made by 31st of July 2020. So you've got a few weeks left. If you haven't yet put a claim in, you can still claim. And if you think you might have made a mistake and underclaimed, then we think you have to get that in by the 31st of July 2020 as well. So the new scheme is CJRS2, or flexible furlough, came in from the 1st of July to the 31st of October. There's a key difference with this one that employees can work, so you can work, bring people back part-time. You pay them their normal 100% of their salary for the hours they're working, and you can claim the furlough grant for the hours that they're not working, that they're furloughed. It is due to taper away to a 60% grant only. So for July, you can still claim the wages, the national insurance and pension. For August, you can't claim the national insurance and pension, still claim the 80%. Tapers down to 70% in September and 60% in October. The key announcement from yesterday is that the Chancellor confirmed that there will be no more extensions and that the furlough scheme will be ending as it's currently planned out. Now, I suppose I summed it up there as both complicated systems. They are hideously complicated. They were written and rewritten as we went along. So the rules and the goalposts have shifted slightly. So it is likely that there might be errors in people's claims, especially where you have variably paid employees. It can be quite complicated to work out what elements of pay form part of regular pay and how you do the actual calculation yourself. So the revenue can inquire for possibly up to 5 years. What the revenue said is to make sure you keep your records for 5 years, which seems to imply inquiry period. They have also said that they can charge penalties, but they'll just be looking to charge those where there's fraud. The legislation doesn't specifically say that, so it'll be interesting to see how inquiries potentially go over the years to come. But as I mentioned, the current furlough scheme will come to an end. The Chancellor wants to focus on getting people back to work. And one of the announcements was the job retention bonus and a couple of job creation incentives as well. So with the job retention bonus, still waiting for the full details, but it looks like a one-off payment of £1,000 to UK employers for every furloughed employee. And that means if you're furloughed at any point for any length of time, whether it was under the first round of furlough or under flexible furlough, but the employees have to be continuously employed after the furlough scheme ends through to the end of January 2021. And they've got to earn on average a minimum of £520 a month, which is the lower earnings limits. So that's for the 3 months, November, December, January. They said that payments will be made from February 2021. And they're linking that to when the RTI filings have been made and processed. So depending on when you make your payroll filings, then presumably that will trigger a payment. We are waiting for more details about the scheme. The Revenue have actually already started to email people about it. So if you signed up for any of the COVID alerts, you may have had an email in your inbox telling you a little bit about this bonus. Basically said there's more detail to come by the end of the month and full detail in autumn. So we'll wait to see what comes on that. Turning to some of the jobs creation incentives, there was a few of these announced yesterday. So we've got the Kickstart Scheme, which is a £2 billion fund to create 6-month placements for 16 to 24-year-olds. And this is aimed at those who are apparently at risk of long-term unemployment. So we're not sure how exactly that will be defined. The funding will cover the wages, the employer's national insurance and pension contributions, but capped at an amount of 25 hours of equivalent to 25 hours national minimum wage. The employers, you can apply from August for this scheme and for workers to start in the autumn. The scheme's going to start running, or will run until the 31st of December 2021. And some of the details still to be seen, but they've got to be new roles. So it can't be for placements that you would have offered anyway. So new roles, and apparently there'll be no cap on numbers. So you can have as many Kickstarter schemes as you like. For traineeships, for those who don't know what a traineeship is, I think they were introduced in 2013. And it's sort of a work experience, if you like, so a pre-apprenticeship aimed at 16 to 24-year-olds with no qualification, no work experience. And typically they were unpaid 6 weeks to 6 month work experience periods. So what's been announced yesterday is that you can collect, employers will get £1,000 for offering these traineeships. There's likely to be some kind of working hours requirement, possibly 60 to 90 hours of work hours to get to your £1,000. These will be capped, we think, at 10 trainees per company. And in addition to the £1,000, you can also claim £1,500 towards training costs as well. So that might be something to consider. Apprenticeships, been around for a little while. New announcement yesterday was that there will be a bonus of £2,000 for employers for every new apprentice hired aged under 25, a little bit less for apprentices aged over 25. And again, they have to be new apprenticeships. The bonus is in addition to an existing bonus that you get of £1,000 for taking on 16 to 18-year-olds. So you could get up to £3,000 if you offer 16 to 18-year-olds apprenticeships. So again, something well worth looking at. So I think on balance, and there are other incentives and funding around for training as well. So it's really good news in terms of creating jobs, but the range and array of incentives is perhaps slightly bewildering for employers. And as yet, we're not clear exactly how all these different schemes will interact, because there's, so for example, a possibility that the Kickstart scheme could potentially overlap with people that you might have offered apprenticeships to. So it'd be interesting to see the detail behind all of these and see how they progress over time. So turning now to the next slide, which is just a few points on property. So one of the sectors that is expected to help with the UK's economic recovery is construction. There's been lots of infrastructure spend announcements and things. I'm not going to go through those, but just wanted to touch on a couple of things on the property side. So in terms of the Construction Talent Retention Scheme, just to mention, it's formally launched later this month, but basically it's an online portal to help redeploy skilled construction workers. There's no cash incentives around it, but it's a free online platform for anyone looking to hire construction workers for their project. There's various funding available for property developers. One of the funds that was announced yesterday is having an increase was the short-term home building fund, which is aimed at SME house builders. So effectively for property development for home builders, and that's going to increase by 450 million. There's a couple of these different funds around. There are quite a lot of hurdles and red tape to get into them, but the funding can be on quite generous terms if you can get into it. We're still waiting for the planning reform. It's widely expected. There's been various details that are pre-announced already, so we're expected that to come any day now, and it's expected to reduce red tape, effectively making brownfield developments easier, and possibly converting commercial premises into residential. So lots of incentives to get property developers on with projects quicker. In Boris's words, I think from his speech a couple of weeks ago, he wants to reduce the newt counting. So even though it's a green building recovery, it's the newts might not be quite up there in the priorities. In terms of green homes, one of the big announcements yesterday was the Green Homes Grant. And this is to cover up to 2/3 of costs for insulation and double glazing, capped at £5,000 per household. We're still waiting a bit more of the detail, but landlords at the moment seem to be included in the same way that private homeowners are as well. So again, it'd be a good incentive for people to look at properties and see what work can be done. And then finally, the big announcement yesterday was with regard to stamp duty land tax, and I'm going to hand over to Dean to talk through that in a bit more detail.
Thanks, Zoe. Good morning, everyone. Yeah, the big announcement yesterday was the residential property stamp duty change, obviously in a bid to stimulate the housing market that's gone a bit stagnant at the moment. So essentially, it's in effect from yesterday. And it runs to the 31st of March 2021. At the moment, it appears to be England and Northern Ireland only, because those are the sort of jurisdictions that pay stamp duty land tax and not land and buildings transaction tax. But I'm sure we might see some further detail on that as to how it affects Scotland and Wales. So essentially, the nil rate band has been extended from 125 to 500,000. And all the other stamp duty land tax bands remain the same. There's a 3% surcharge for second homes and corporate purchases, and that remains in place. So it will reduce the cost of buying a residential property into a company, for example, but there still is a charge, just so you're aware. And for those more niche transactions, it also applies to leases on residential property. So the 125 threshold has still gone up to 500,000, and then above that, it's now 1% of the net present value of the lease cost. I won't go into any more detail on that one. I've got a couple of examples on the next page, just to give you a bit of a numbers idea of what this means. So for a residential property purchase of 425,000, there's no stamp duty going to be payable to individuals on this if it's their main residence. That normally would have been 11,250 if you work through the stamp duty calculators. Just to give an example of either a second home, an investment purchase, or a purchase by a company, the SDLT charge on that would be 12,750. Normally would be 24,000. So you see that still a saving of 11,250, but that reflects the 3% charge on it being a second home. And then obviously, if you're lucky enough to be buying a house for 600,000, the stamp duty charge has been reduced down to 5,000 from 20,000. So a £15,000 saving. And a residential purchase of £1 million. So if you're really lucky and you're buying a really big house, the stamp duty charge would be 28,750 instead of 43,750. So what that illustrates is if you're buying a house over 500,000, the maximum saving you're going to get is a £15,000 saving for doing it before the end of March. So that throws up one or two things to think about. So if we can have a look at the next slide, just some areas to think about when we're considering the stamp duty changes, the temporary ones. Obviously, the timing of transactions is going to be important, especially as we're near the end of the year and the beginning of 2021. Normally, stamp duty is payable on completion. So if you're sort of getting near the end date, then there might be some consideration of how we can get that done before the stamp duty changes apply. We don't know yet how it affects properties in Wales and Scotland, but watch this space and see if there's any announcements. And one thing to watch for as well is mixed use properties. Where there's a residential interest that's mixed with a commercial interest, the default position is that you'll get taxed on commercial stamp duty rates, and that would normally be possibly more beneficial, but in the current circumstances, that's likely to mean you don't get the stamp duty exemption up to 500,000. So there's definitely some numbers to be done there. So yeah, watch out for ones with commercial properties at the side, maybe some commercial stables, things like that. So if you're buying a big property, you just need to take advice up front as to what your stamp duty position is likely to be, and not to assume that it's going to be okay. And then on a tax planning or a wider scale, certainly for residential property landlords, be things like looking at the interaction with reliefs such as multiple dwellings relief if you're buying multiple properties, and also any other tax planning you may be doing in transferring residential interests. There's sometimes a stamp duty cost, there's sometimes some tax planning to get around stamp duty costs, but of course if there is a transaction cost to be had, then that might be less in this current period due to the bigger exemptions available. So it's always worth having a chat with us to see what can be done. And it also might stimulate some of the downsizing, given that might be a barrier. You know, the stamp duty cost might be a barrier to downsizing. That might be an opportunity for people to downsize as part of their estate planning. So it's always worth having a chat with one of us to see what position that puts you in. Then there's a subject now that I'm probably just as qualified to talk about than I am about stamp duty, and that's eating out. I'm going to quickly run through this because I think there's not a great deal of tax content, but I think it might be just interesting to cover what might apply, especially if you run some premises like this as well. So eat out to help out. There's a 50% discount on meals and non-alcoholic drinks when eating in. It's going to dovetail with some VAT changes as well, which my colleague Andy will talk about afterwards. But essentially the Eat Out to Help Out scheme is a 50% discount capped at £10 per diner. Takeaways, I believe, are excluded, and it's Monday to Wednesday during August only, and it can be used unlimited times. So be a race to see how many people can save as much money in August as possible. I'll be giving it a try. And there is going to be a registration scheme. So as participating restaurants, cafes, pubs, you have to apply for the scheme. The list of our participating outlets will be on the gov.uk website, and discounts will be applied at the point of payment and will interact with other offers and discounts that are currently available. So it'll be a 50% off at the final bill. And as I understand it, that will be a recovery for the outlet in fairly short order from the government once they apply through through a portal or some sort of scheme when we see the detail. Just move on to the next slide, Nick. Yeah, so it's a measure to stimulate the hospitality sector that's obviously on its knees at the moment. There's going to be some interaction with the rate cut for VAT down to 5%. And the expected cost of this is £500 million. I think for people that own these establishments, the key thing is going to be getting things ready for the 3rd of August launch. So applying for the scheme online, updating their internal systems to account for the discount and be able to have robust things to make sure that it's being done properly. And obviously the trade-off here is ensuring that their premises are COVID friendly, if you like, for having people to dine in if they haven't done so already. I think the paradox here is going to be it may be cheaper to eat in than actually take away, which be interesting to see what the actual rules are, but it seems a bit of a strange message to give in the light of where we are. So it's a welcome boost for these establishments, but I think there's going to be some area of abuse, some area where people can try and cheat the system, if you like. So it'd be interesting to see what anti-avoidance there is to combat this for the sake of 1 month. And obviously for restaurant owners, it's managing how things look in July, waiting for people be waiting around, waiting for the 3rd of August for their half-price meals. So it's just about obviously managing your pricing and everything else for July. So just some things to think about, really. And I'll let my colleague Andy talk about the VAT changes in respect of hospitality.
Thanks, Dean. So morning all. So like Chris said earlier, it's been quite a long few months since March, and there have been various VAT announcements in the last few months to help with COVID-19, I suppose, including the VAT deferral. Lots of rumours leading up to the announcements yesterday about whether there was going to be a headline rate cut or a main standard rate VAT cut. I predicted that would happen, but I was wrong again, and it hasn't. But I suspect that might be a precursor to the autumn budget, and we might see some more changes later in the year. But what the Chancellor did announce yesterday was, and I suppose linked to what Dean's been saying, an important stimulus for the hospitality sector. So a reduced rate of 5% for the hospitality sector. VAT's been used historically as a stimulus for in times of economic problems, I suppose. And we saw rate changes in 2008 and 2009 at sort of the time of the financial crash. But this is a very much more focused change to help a particular sector, and essentially applies in two main areas. Firstly, in relation to food and non-alcoholic drinks, supplies from restaurants, bars, cafes and similar establishments. Importantly, and probably disappointingly for some landlords, and there's been quite a lot of objection overnight, I suppose, to the extent this applies, alcohol sales are specifically excluded. And it will also apply in the sort of secondary area to accommodation and attractions, so hotels, caravan sites, cinema, theme parks and that sort of thing. So as with some of the other changes that the guys have announced, we're expecting lots more detail in the coming days, and we'll be obviously updating clients as we go forward. But a really supportive measure, I think, for the hospitality sector, and something that we would support as a firm as well. However, I suppose with everything VAT wise, it comes with a note of caution as well. So if we can just flick to the next slide, Nick. I suppose, firstly, how will the benefit pass to consumers? What will the impact be on pricing? I think businesses have obviously got to make some important decisions around that. I suppose in line with the principle yesterday, the Chancellor announced around job protection and industry protection, it may make sense for rather than a stimulus to consumer demand, that actually businesses hold prices and take the benefit of the VAT change themselves. So there's some interesting developments to move forward on that one. So whilst we support it as a stimulus, it is also costly to change the rate, and we saw this, historically with the last time there's rate cuts back in 2008, 2009. VAT accounting processes will need to change. There will need to be changes to systems, particularly for those restaurants and pubs and outlets. There will need to be changes to the way that point of sale transactions are accounted for. Again, not necessarily straightforward, and some investment may be needed. Again, from a timescale perspective, introducing this from the 15th of July next week till the 12th of January is potentially, doesn't give you long to prepare for it, and is also potentially only a short period of time that you have to invest in those changes and then make changes back in January. And also the issue of sort of changes partway through a VAT period as well may not help with your end-to-end VAT accounting processes and treatments for preparing for VAT return submissions to HMRC. So
Andy, we have a question from the floor that's linked to that actually, which is caravan parks charge owners up front for the year for the site fees. Can they ask for credits due to the VAT reduction?
So it's a good question. So there'll be lots of, I suppose, two things with this. One, HMRC may look to introduce, and they certainly did this previously, sort of anti-forestalling legislation to stop planning around the rate cut, and also when the rate goes back up again in January. I suspect for payments that have already been made, there's an argument that's already created a tax point for VAT purposes, so it's actually triggered a liability based on the old rate essentially. But I would expect that there would be some detail in HMRC's further detail that may provide businesses with some flexibility to account for that, but it's something that we'd want to follow up as part of the next tranche, I suppose, of that's when the details release, Chris.
So as it stands at the moment, the VAT point is determined when the payment's been made, and we just need to see whether there's any legislation that says that you can claw some of it back for the amount paid in respect of a period post change.
Yes, exactly, and this is going to impact on hotels and the like as well. So if people already have hotel bookings that they've already prepaid, what's the impact on the VAT position, and similarly how that is then managed when the rate goes back up in January. So whilst it seems quite a simple change just to reduce the rate to 5%, there's a wealth of complications and questions that arise out of the back of it that we're sort of keen to see the detail on.
Great, thanks, Andy.
And I suppose the other one linked to that is around split supplies in pubs and restaurants. So your typical burger and a pint type transactions. How are they treated? Do you have to apportion the VAT, or can you just focus on the main supply, which presumably could arguably be the food? So effectively getting some of the alcohol supplies into the 5% rate. So I suspect there may be some planning and opportunities that businesses can consider around that as well, subject to what HMRC released on the detail. One of my colleagues yesterday was sort of asking what's the line with gin and tonic. Obviously you've got alcohol and tonic, non-alcoholic. So you can see VAT, some probably ridiculous questions that probably need considering, and obviously we're keen to help on those. And again, linked to the detail, I think probably HMRC will look to stop planning arrangements around when the rate goes back up again, sort of into January. Certainly did that last time. So obviously we'll be keen to support on any changes or legislation that's introduced as well. Interestingly, there has been some commentary overnight as well about whether the UK is allowed to reduce the hospitality sector to 5%, given we're effectively still in the EU and in a transitional period. However, I think it would be extremely harsh of the EU to introduce infraction proceedings in the UK, given the background of COVID and current economic uncertainty. But certainly watch this space on that one as well. But I think it's a positive move if you can manage all the admin issues in the background.
Great, thanks Andy, thanks Dean and Zoe. I think that was very well done actually, and lots of good detail in there. We had one question that was answered live, which was about the caravan parks. We also had a question about the eat out discount, which we now know that Dean is our resident expert on. So obviously you can forward any queries to Dean.
I'll report back during August.
Thank you. Yeah, a labour of love. Obviously, we're here to support you all. We will find out the detail over the next few days and try and get it out either via social media or e-shots. You can always contact your normal BHP contact to pick up specific issues. And other than that, if there are no other questions, then we will say thank you very much to everybody. Have a great day.